Welcome back to Turning Hard Times into Good Times. I'm your host, Jay Taylor, and I'm really glad to have with me once again Michael Oliver. I haven't talked to Michael in some time. He's a regular guest on this show. He is a technical analyst that has really cut his teeth many years ago with the likes of E.F. Hutton, International Commodity Division. He has been an advisor to other mainstream, large international financial concerns over the years, more recently, I should say, Wachovia Bank's trust department. And so welcome, Michael. I'm really glad that you could be back with us again today.
Good to be back, Jay.
Good to be back, and I should tell our listeners again, remind them to keep up with what you're doing and also to learn more about your service. They should go to olivermsa.com. Oliver, M as in Mary, S as in Sam, A as in Albert, olivermsa.com. Well, Michael, you and I have been talking now for, a year and a half or so on this show, I suppose. And, I'm a student of geology, so that whole picture of plate tectonics, the shifting of major markets and major plates that you talk about some time ago about you felt that we were nearing a major tectonic shift in markets like stocks, bonds, precious metals, and commodities. Now, on September 16th, you put out a missive titled, Higher Long Rates on the Way. Good night to central banks. Now, by that, did you mean that interest rates will rise no matter what the Fed tries to do, no matter what the Fed and other central banks try to do?
I think that in piecemeal layers over the last, since early this year, the central banks have begun to lose control over markets. And so the myth that accompanies that, the religion based around the Fed put idea, is starting to crumble. The first evidence came when the European bond markets, this would be Germany, France, Italy, Spain, so forth, their debt instruments, which had been driven to extraordinarily low interest rate levels, where Italian bonds were yielding less than U.S. notes, so comparable duration. That changed dramatically in March, April. There was a mini crash in those markets where the yields shot up, prices dropped, and they've really not gone back to where they were before. So that major stumble and that was not policy by the ECB, by the way. That was not what they wanted. So the markets got freed. They cut their tethers. Now, there's more to go, but I think the rise in long rates, and I don't mean high-yielding debt markets, because those are rising sharply right now. We know that the high-yield market is rising. It's the safe stuff, like the U.S. T-bonds, T-notes, the German Bund, those markets that people fly to when the equity markets get rattled. And sure enough, in the last several months, we've seen a sharp rise in U.S. T-bonds, for example, drop in yields. The bonds have stabilized and firmed up. Not because of any great merit in those instruments or that rates should be that low. It's that those are flight to safety instruments still. I suspect after the first major low of the first wave of the stock decline, which I do not think we've seen yet, that at that point the rush of money to get into T-bonds and to bonds for safety will abate. And at that point, then the drop in yields in those safe long-term instruments will shift the other way. Prices will start back down. Rates will start to rise. And at that point forward, and I suspect this is sometime early next year, we'll see this, you'll start to see long rates rise naturally, regardless of central bank wishes to the contrary. What we're talking about here is not the high yield, but we're talking about the stuff that's under their control, supposedly. I think we'll start to see a rise in long rates. That's one of the big plate shifts out there. Stocks have, as far as I'm concerned, stocks have done it. They have shifted.
That's really interesting because what I hear you saying then, Michael, is that the markets will at that point possibly be losing confidence in the ability of central banks to orchestrate good times.
That's right. I think it's not a push-button situation where everybody suddenly says, oh, my gosh, it doesn't work anymore. It's a phasing thing. If smart money realizes it first, and then pretty soon the mob realizes it, and then everybody wants out the door, whatever the door might be at that point, whether you're talking about the bond market or the equity markets and so forth. So there's a lot of big movement. I'm not talking just net price movement either, or net yield movement going on. It's also the relative performance of these asset categories when you measure them on a relative spread basis. Not look at gold price, but look at gold price in relation to the S&P. Not look at the Bloomberg Commodity Index, what it's doing up or down net price, but its spread relationship, relative performance to the S&P, which is bottoming, clearly. In fact, we're not far from a major breakout. Meaning, after years of decline in commodity prices, not just in net terms, but relative to the S&P, that is shifting, and it's measurable. And I think that's the argument of further deflation because of these distortions that have been created over especially the last 5 years. I think it's run its course pretty much in the commodity area. Now that it's going to rotate to the equity arena and probably also to the long bonds and so forth. And we've already started to see the evidence of that, for instance, the S&P recently.
Yeah, I just like to remind, my listeners, and one of the things, Michael, that really makes you so valuable to me in my thinking is that, you have you have a sense of, as much as anybody I know, of the fundamentals, but you're not judging your investment decisions strictly on your perception of the fundamentals. You're looking to the technicals, the technicals to verify and to tell you what's really going on. You don't trust your sense of what the markets are doing. You're letting the collective wisdom of the market speak to you. But at the same time, you have a narrative for what you see happening in the markets overall, and I really, really do appreciate that. I would like to mention that on September 20th, you wrote to your subscribers that QE-sponsored bull market in stocks is over. But Michael, I read in the New York Times today on talking about the Monday's stock performance. It said stocks soared on bad economic news because it suggested the Fed would wait even longer before raising interest rates. So, obviously, at least as of yesterday, the market still thought the Fed would continue to print money, keep stocks higher, keep the good times rolling. So what is your technical work telling you that convinces you the party in stocks is almost certainly over?
Well, I measure via long-term momentum metrics, not just price chart stuff. I convert price to momentum. And the trend there is clearly destroyed. The momentum trend is just blown off the page. And it usually will lead price. In other words, you'll see a momentum breakdown or a turn up, and then price will, like a puppy dog, follow it. And there may be a time lag. Momentum already started to deteriorate in January, broke a lot of stuff. And then we went up to, had a predicted high for the year 2130. That's where we went twice. They went up there. And then in August, we dropped through a number that I thought was the final number. If you hit it, it's over. And it was 2041, to be precise. After we hit that number, in the next 8 market trading hours, the S&P dropped 174 points. So it tended to validate my number. I think that the top is in place, and all the gyrations we're seeing for the last month and now going into the second month here of October is noise. I think it's congestion, way off the highs, that is designed to, if you want a psychological reason for it, to scare the bears, especially those who got short late, and make the bulls feel comfy. I suspect, and I said this in the last weekend's report, that this rally, based on that Fed put assumption, caused by that rotten unemployment report, the Fed will never raise rates now because of the numbers are breaking down. That is the last one you'll ever see of any quality. And when the market goes back through the lows again, let's call it the 1880, 1870 lows that we made in August. When you penetrate those lows, whether it's next month or what, that those people who bought for the last time based on the Fed put will finally give it up. They'll say, it didn't work. This time we didn't go to a new high based on that.
Well, that makes sense. Again, collectively, more and more people lose confidence, and then the boat tips the other way, I guess. Regarding gold, I think it was the last couple of weeks or so, last week or so, you suggested committing 75% of the maximum amount that you would allocate to gold, that you want to allocate to gold in the future. What is your work telling you now that is continuing to bolster your confidence in the gold market?
Well, it continues to behave well. I mean, it can, anytime it's not completed the base yet. I think completing the base, as far as I'm concerned, is to get a monthly close and a price action up in the low 1200s, between 1206 and 1210. I've got a lot of numbers. That's $50-some-odd above where today's high is. The process of getting to the final momentum breakout level is almost always, whether it's a topping process or a bottoming process, in this case a bottoming process, an arm wrestling match. And so, as you accumulate positive indications, they don't all instantly turn into a party. You don't just explode $200. Now, there is a point at which I think gold is open for that potential, and I think it's once you get beyond the low 1200s. I've got various numbers I put in my reports for various indicators but they're all between, let's say, 1205 and 1210. And if we can get up in that area during the current quarter, or especially this month, I think at that point the arm wrestling match shifts very dramatically. And you could get some speed on the upside at that point. Much like the S&P going through that 2041 level in August, suddenly instead of having this arm wrestling action that we'd had in the S&P all year long, bam, the market shed to 175 points or so. And I think gold could be facing that as well if it can get up into the low 1200s.
Well, the arm wrestling picture is an interesting one. Seems to make a lot of sense because, once you get past a certain point, boom, the arm goes right down level to the table, right? And Dr. McHugh, who I talk about on this show, and he's been on a few times, is steadfastly suggesting that we're going to see, or he thinks we'll see, 1450 in the gold market before the end of the year. That seems impossible right now if you look at where it is. But using that arm wrestling picture, you could kind of see that if you get through the resistance levels, and there's no stopping it perhaps for a while. Just one more go ahead.
No, I agree with that. Yes, totally.
Yeah, just with the next 30 seconds to a minute, maybe we can go that long. Talk about silver. I think you're turning quite bullish on silver, and we know that silver does better than gold when the precious metals enters a bull market, does not so well compared to gold in a bear market for precious metals. But what's your work telling you now about silver? You seem to be turning quite bullish on silver.
Yeah, silver is actually a bit ahead, a bit closer to its major breakout levels than is gold. Of course, you want to see both of them break out. You want to see gold clear that low 1200 zone. But silver today got up over $16, and my highest number is about 1612. 16.12 if I could close a month there or higher. We traded over 16 today. So it's actually chafing at the bit to break out first. And the spread is changing. In other words, the amount of ounces of silver it takes to buy an ounce of gold at the peak of the bull market back in 2011, it only took 40 ounces of silver to buy 1 ounce of gold. That changed to the point where recently we've had as much as 77 ounces of silver to buy 1 ounce of gold. That's starting to change. So the fewer ounces, it's now down to about 72. And the spread looks like it's about to change, meaning if it changes, it indicates that silver is going to outperform gold, and that's exactly what you want to see if you think there's a bull market in precious metals coming. And I think that evidence is starting to show itself.
All right. Well, thank you very much, Michael. We're out of time. It always goes so fast with you. Thank you again for sharing your wisdom and your time with us, and we'll look to do it again hopefully next week or sometime very soon in the future. Thank you. Thank you so much. And again, folks, it's olivermsa.com, olivermsa.com, to follow up with the work of Michael Oliver.